My name's David Richardson. I'm Managing Director of Research at the TIA Institute, and it's my pleasure to be the moderator for the afternoon sessions. I'd like to thank Olivia and her staff for having another outstanding conference. It's already started off a great morning discussion, and we're hopefully, and I know we're going to have more this afternoon. The afternoon session is entitled Retirement, Debt, and Financial Fragility at Older Ages. For our company, for TIA, financial fragility and financial wellness is become a really, really big deal. And not just for people at older ages, but for people at all ages. And then, as we know from this morning, we had a lot of discussion around kind of different pain points for both millennials all the way out to boomers and maybe even the silent generation. And I'm really looking forward to seeing the research that's being presented this afternoon. We're going to start off with Anna Lasardi, who's going to talk to us about financial vulnerability in later life and its implications for retirement well-being. Anna?
So thank you very much. This is actually one of the 3 papers we have written so far on this topic, and it's joint work with Olivia and with Noemi Oggero, which was one of our research assistants, and she's back in Italy doing her PhD. And I'm going to start today talking a little bit about, in a sense, the original motivation that almost 10 years ago, I have to say, brought us to study this topic about debt, and in particular debt close to retirement. And one of the motivation, even though I think we definitely need to add on all of these additional reasons that we have heard, in particular this morning, is that the access to credit is become much easier. Certainly before the financial crisis, not just the subprime mortgages, but for example, credit card, for example, payday loans and these alternative financial services. You can borrow against your retirement account and so on. And this can be, of course, having an impact on how people accumulate wealth and also how they borrow. Certainly, both on the asset side, but then on the liability side as well, these products are more complex. Think of the mortgages. They are not anymore the plain vanilla ones. And when you talk about that, and some of you were, for example, mentioning this morning, and I really do think, and we have done some of the qualitative work, I think the consequences of managing or mismanaging debt are very different than, for example, not saving for retirement. Perhaps the lack of saving is more silent, while if you mismanage debt, there are people calling you or there are consequences coming up rather quickly. So that's actually what originally brought us to study this topic. We have written a set of papers, for example, using the HRS, documenting that cohorts, the most recent cohorts, had, for example, taken up a lot more debt than previous one, and in particularly housing wealth. We have also documented that there are actually evidence of more vulnerability connected with this debt. And also we had documented that even the debt literacy, so even though people carry so much debt, in fact, they often do not know how this debt works, and for example, how much debt can grow because of the higher interest, which are normally charged on that as well. And I have to say, we are very grateful to the TIA Institute, which has supported all of the research, including actually the paper that we are going to present today, and also the support of the PRC. So in this paper, what we are going to do, like in the other paper, we are actually going to use, in a sense, a simple life cycle framework. And kind of this idea is, people close to retirement should be at the peak of their wealth accumulation. And so there are some predictions you can make of that, because if you should have, in a sense, not just the highest wealth, but also the return on your asset potentially should be higher than the debt that you carry. And that's why when we look at this very high return or very high charging debt, like the alternatives financial services, it's hard to reconcile why is it you are close to retirement and still carrying credit card debt, or using alternative financial services and so on. So we want to also talk about the fact that this doesn't seem to be consistent with some of the prediction of the life cycle model. We are going to use a third now. I'm going to talk about a different data set. This is the National Financial Capability Study, and I'm very glad that Gary is here because FINRA Investor Education Foundation, I think with this new data that started in 2009, I think has provided us with an opportunity to, first of all, have a very large sample, so we can study even a small age group. I'm going to focus, for example, on the 56 to 61 years old, but he has information not available either in the SCF, the HRS, and so on. So this is, I think, a really important tool to use even when you study this age group. And I'm going to talk and try to give a little bit more, in a sense, an in-depth insight, first of all, but what explained that close to retirement? Why is it that we see many carrying that close to retirement, and try to look a little bit more at the heterogeneity. Today and this morning, we have looked at a lot of aggregated data, and I think it's important that we pay attention to the different group, because when it comes to that, certainly one size doesn't fit all, and I think we need to look at who are potentially the most vulnerable group, in particularly in carrying that close to retirement, and potentially actually having difficulties with this debt as well. Let me actually tell you potentially a little bit about the National Financial Capability if you don't know it. And I have to say, it is really this data back in 2009 that motivated me to look at that. Because even in 2009, one of the things that emerged from that data and from that report, how much that was widespread among almost every age group, every socioeconomic status, but it was a very, very different type of debt. And this data is quite rich and is quite informative. We are going to use the most recent data. Even though I restrict to a simple age group, we have more than 2,600 observations. So because we have more than 27,000 observations in the National Financial Capability Study, it's really a great data set. And we have some unique questions that I'm going to actually talk about when we can look at not just, in a sense, the data itself, but I want to almost get, we don't have, in the 2018, I'm happy to tell you, Dave, we have actually, we have indicator of financial well-being, but we have to wait until the 2018. On the 2015, we have some indication of like burden of debt and what I call also financial fragility. So let me actually start by telling you that even if you restrict in this age group 56 to 61, so we should be very close to retirement, we chose 61 to be kind of before they can withdraw Social Security. And the first thing is that people carry, even close to retirement, mostly two types of debt: collateralized debt, for example, home mortgages, home equity loan, and auto loan. We have information whether they have student loan, and in particular for themselves and others. And I'm going to focus on the student debt just for their own education. And we have information about alternative financial services. I'm talking about payday loan, pawn shops, rent-to-own, and auto title loan. And then we have information about the credit cards. And I'm going to distinguish here on the credit card about two behaviors. One, if people just carry a balance, and what we call instead using the credit card in an expensive way. So if you pay the minimum only, if you are charged a fee for going over the limit, or if you use it for a cash advance. So a fee that, in a sense, a behavior that generates a lot of fee and interest. And one of the things I wanted to show you, if you distinguish across the education group, what you see is that the higher income people, as we have said this morning, they carry the mortgages, and they have mortgages kind of close to retirement, and many of them do, and also auto loans. But interestingly, instead, is the people with the lower income who have even a high proportion of the student loan that actually they took for themselves, You see certainly a divide when it comes to income in terms of who uses these alternative financial services, and 30% of these low-income people are actually using these alternative financial services, and they are also using the credit card in an expensive way. So, like, you know, there is a large difference, perhaps a dichotomy when we look at the debt behavior, certainly across income group, for this group close to retirement. When you look at also at the ethnic group, and I think we need to talk about race and ethnicity because it's very important. And I think, you know, one of the things that the data speaks relatively clearly about is, for example, that the African Americans have a debt behavior which is very different than the others. And I just wanted to point you to the high proportion of, for example, African American that they have student loan for themselves, and also how much they use, for example, alternative financial services or credit card in an expensive way. So when we look, for example, at all of this behavior by itself, and we have also done a factor analysis, you almost see like this behavior grouping in two specific groups, which is, in a sense, debt, which we might think is a normal and is not an indication of problems, but is what people normally do. You know, they are wealthy people, they have a house, they have a car, and so on. But if you look at the, for example, behavior like alternative financial services or credit card, that's more an indication of financial distress. And very interestingly, this is actually positively correlated with your own student loan, the loan you carry for yourself. If you look at the student loan for others, it's actually a negative correlation. So this type of debt later in life for yourself seems to be an indication of issues, in the same way in which if you use your credit card or if you use alternative financial services and you pay the minimum only and so on, this could also be an indication of potential financial distress. So we have a lot of information in the National Financial Capability Study, but we don't have information about values. It's actually very hard to measure wealth, as, for example, John Sabelhaus knows from the Survey Consumer Finances, so we don't have enough information to measure the value. And so we had to look at proxies, for example, whether debt is high or not, whether people have enough, for example, asset or not, and so on. And so in 2012, new questions have been added to try actually to assess what is the financial position. And so we are going to look at three indicators potentially of financial vulnerability. One, I call it financial fragility. This is a question that was tested in 2009 in another survey. Then some measure of debt burden, and also some measure like this morning in the paper of Karen, like whether people are able to make ends meet, just as another simple indication of how people are doing. And we want to look at, in a sense, you know, who suffer from this problem. Again, this is people close to retirement. And also what are some of the determinants of that financial vulnerability. Let me turn very quickly and tell you that the measure of financial fragility is whether people are able to come up with $2,000 in 30 days. The reason why this is a very rich question is because it measures not just lack of asset, but also how indebted people are. So it's actually linked as well to that. And very interestingly, when you look at this age group, a third actually couldn't come up with $2,000 in 30 days. These people should be at the peak of their wealth accumulation. But in fact, they often do not have this liquidity, and this number is a little bit better than in 2012, but still is a high proportion. When we look at debt, we had the questions about burden of debt, and in particular whether people basically think themselves they have too much debt, which we think is a measure potentially of over-indebtedness. And 36% of people actually told us that they have too much debt. And when we look at a simple measure, for example, how difficult it is for you to cover your bills and your expenses, In this age group, yet again, we find that 45% tell us they are actually unable to cover those bills and pay their expenses easily. So, there is an indication that, this age group close to retirement, at least in some of them, there is some evidence of vulnerability. And of course, I want to talk also about financial literacy, both because this information is available, but because in 2012 we have also added the questions about debt literacy. But one of the things I wanted to show is that, even close to retirement, people, it's not that because they have made a lot of decisions that they have acquired a lot of knowledge. So if you look at people, for example, even close to retirement, in fact, not even half can answer 3 very simple questions that measure knowledge of interest rate, inflation, and risk diversification. So does all of these things matter, and what does it matter? What this regression tells us is that there is a lot of heterogeneity in the people that are vulnerable close to retirement. Certainly, financial literacy is a way in which that I would say is something that can help you in being less financially fragile. And so those who are financially literate are less likely to be vulnerable, even after we account for income and education and other a lot of demographic characteristics. Women are substantially more likely to be financially vulnerable close to retirement. And then when we look at the other demographic variable, and these are the variable in a sense that we expect, so those which have dependent children and certainly income are other important determinants. And this is just to say that when we look, I think, at this group, we have to take care of the heterogeneity, and we have to definitely look at, for example, income, gender, and also knowledge and education. So we tried in the paper to also understand, but what is behind this black box, in a sense, what brings some of these people close to retirement with often either too much debt or perhaps too little asset. So we have explored the importance of financial literacy. We have also explored lack of information. And so in previous wave, for example, of the national financial capability, there is some information how much people search for interest rate, how much they know, for example, about the interest that they are charged on their loans, their credit card, some of the things they do. And again, we see a lot of financial naivete often behind this. And we have also explored, not in the data because we don't have information, but also behavioral biases, for example, lack of self-control, impulsivity, for example, the fact that people linearize and they don't really know about the power of interest compounding and so on. And I think the literature as well seems to indicate that all of these factors can be important to potentially explain wealth close to retirement. So to conclude, as we look at the financial vulnerability, I think we need to pay attention to the group that are potentially more vulnerable, and certainly are those with lower income, ethnic minorities. So that heterogeneity, I think, is really important. In particular, the short-term uncollateralized debt is important, is the one that charges the higher interest rate. And even at an older age, I have to say, the student loan is not a problem just for the young, it can be a problem for the old. And so I think it might be really important as we think of, for example, workplace financial wellness, to really focus not just on retirement saving, but also how to deal with debt and debt management. Thank you.